Hello, and welcome to this live webcast on the implications of the financial crisis for directors and officers. For boardrooms all over the world, the economic downturn is creating a high degree of unease, with directors under fire from investors and the wider public. It's not just a matter of shoring up the balance sheet, it's the growing threat of litigation faced by individual directors. I'm John Willman, for many years a senior journalist on the Financial Times. Today I'm moderating this live roundtable where we'll look at how boardrooms can face up to the issues I used to cover on that newspaper and which continue to dominate its headlines today. And to help point a way forward for boardrooms, I'm joined by two leading experts on the challenges faced by company directors. Steve Wilson heads up the Zurich Financial Services Global Specialties operation, which includes the D&O proposition. Kim West is a partner in Tucker Ellis West LLP, a leading US law firm, and he has considerable experience in defending lawsuits against directors and officers. You can also join in this round table by sending your questions or sharing your experiences with us during the live broadcast. We'd love to hear from you, and we'll try to take your contributions live in the next 30 minutes. To submit questions, follow the instructions on the web page, and any questions not answered live in the debate will be responded to online by my guests for an additional 30 minutes afterwards. Now, Steve, what do you see as the impact of the financial crisis on the D&O market, and what does it mean for directors?
Okay, John. Well, when we've looked at this, we've looked at previous economic situations that have impacted D&O significantly. We've looked at the savings and loans crisis in the US, the dot-com bubble, and of course the corporate governance scandals of Enron, WorldCom, Tyco, etc. But what we see here is really something quite different. It's a very broad economic situation with many industries being affected. It's very deep. I think that's well known to us all now. And the additional spin on it, if you like, is the public backlash against some of the remuneration policies within the banks and with the financial traders and so on and so forth. So we're seeing a much more aggressive position from regulators and governments, supported by the popular press, of course, which is creating a different dynamic than we've seen in the past.
And Kim, on your side of the Atlantic, these things hit you before they hit us over here. Are you seeing a similar picture over there?
Well, very much. What originally began as a subprime financing crisis has evolved into a credit crisis and now a global financial crisis. In the past, leverage was encouraged and rewarded, and now it's being punished. As a consequence, any entity with a weak balance sheet is in trouble because they can't restructure their debt and they can't obtain new financing. So as a result, you have a situation where the strong will survive, the weak will either perish or be acquired, and it's really a situation of Darwinian type proportions. It's a survival of the fittest. In this environment, there is very much more litigation. Last year, in 2008, there were 210 securities class actions filed. More than 50% were against financial institutions. So what's happening? The directors and officers of publicly traded companies are being held accountable by shareholders, by regulators, and in situations where the companies are going under, by the bankruptcy trustees. And so far, they've not been treated with much sympathy by the courts.
And what are the trends you're seeing, Kim, on the sorts of cases that are being brought?
Well, once again, in the financial institutions sector, the trend is not surprising. It's a horrible trend. As I mentioned, more than 50% of the securities class actions last year were filed against financial institutions. Most of those cases have not settled. They're still in the pipeline. In fact, in 2008, fewer cases settled than in prior years. So far in 2009, there have been 29 financial institutions that have failed. 4 failed just last Friday. So as a consequence, I think this trend is going to continue in the FI sector. What I think is going to happen is because of this, there's still this pipeline of cases moving through the courtrooms, that the settlements are likely going to occur in this year and in 2010. The settlements could be very serious. The average market cap loss last year was around $350 million, so that there's a potential for severe losses, major settlements, but it's going to depend in large part on the ability of the company to pay.
And what are the trends you see over on this side of the Atlantic?
Yeah, so I think the first thing to say is, of course, the class action system in the US is very powerful, and that's been a major source of claims on that side of the Atlantic. But of course, any European institution with exposure through a US listing or other exposures in the US can get brought into that. But I think it's important to not see the issues facing directors and officers as just being driven by class action legislation. I mean, as Kim, I think, alluded to there, in a recessionary environment, there is a tendency for insurance claims to rise. And what we're seeing in Europe is more cases for wrongful trading. So that's when a company is bankrupt and the directors and officers are still trading. They can then be sued on that basis, and that's not a great situation. Their company's gone bust and then they're getting a personal lawsuit as well. Or we're seeing employment practices liability rising to the fore with a lot of redundancy programs. That again is driving more claims costs. And in some territories, for example the UK, we bundle the industry bundles the directors and officers and employment practices covers. So if it's being used for to defend or pay out on an employment practices claim, then that's reducing the available cover for Ds and Os. So there's a number of factors that the directors need to be aware of when they're looking at how they set about protecting themselves.
John, in the FI sector alone, the statistics I gave you actually don't reflect the true exposure, because a lot of these, in the securitization market, a lot of these securities are sold in a private placement. So you have purchasers of mortgage-backed securities and collateral debt obligations or private purchasers. So when there's litigation between the purchasers of those securities and the investment banks, that litigation is not even reflected in the statistics that I gave you.
So there's more coming down the turnpike. What about the rest of the world, though? I mean, we've talked about Europe and the US, but Latin America, Asia, Russia, Australia, what's happening there, Steve?
Well, if taking Latin America, and of course Brazil is the dominant economy there, we see a very similar situation to the US and Europe. And by the way, what we'd say in terms of the D&O markets themselves, there's been a very rapid reaction to the issues with banks and other financial institutions, and underwriters have taken quite strong pricing action there, reflecting this increase in risk. We are just really at the beginning of seeing that in the commercial space, but Brazil is following that kind of pattern. Asia right now is a calmer situation. The litigiousness of that environment isn't yet in the same proportion as certainly the US or Western Europe. And then Australia is a little bit of an oddity in that it has its own the peculiarities of its own legal system, which makes it a very tough market for D&O insurers. And I don't know if you have some thoughts on that.
Yeah, Australia is very different. Australia has a more highly evolved class action system, so it's so they're already familiar with the class action context, and on top of that, they have what's known as litigation funders. These are essentially investors, sometimes financial institutions themselves, that take a stake in the litigation. They fund the prosecution of the claim. They participate in the recovery, and of course there's a loser pays rule, so they're on the hook if there is a loss. But essentially, the use of the litigation funder almost creates a contingency type environment for the plaintiffs in Australia.